I'm Dan Mullen, the CPA mortgage guy. I have been a CPA since 2015. I noticed over and over that the difference between my struggling clients financially and those who are comfortable and even wealthy was real estate, almost always. And I'm not sure if that was a cause or effect. It's certainly in there. I started to study real estate quite a bit. And the more I did, I started investing in real estate. I've got a couple rental properties. I couldn't help but be more involved in real estate. And I did that because I just had to. And I didn't want to be a real estate agent necessarily. So I kind of figured I'm a little bit of a numbers guy. Numbers plus real estate equals mortgage. I mean, I still serve clients on the CPA side all the time who are real estate investors or real estate agents, or those who are self employed trying to qualify for a mortgage because their taxes have quite a bit to do with that. I always say in times when I'm talking to clients about taxes, especially who are novice in taxes, which is most people aren't tax professionals. That's okay. I'm glad because our world would be boring as all heck, right? So when I'm talking to people who are not up to speed on tax law, or it's not their expertise, I get a lot of misinformation, and I don't blame them for that. Again, I went to school for this. I've done this for many years, and they just don't understand how the tax code works, and especially, and I meet CPAs and loan officers who don't really understand the bridge between that gap between how your taxes affect mortgage qualification, and that's a huge gap that needs to be addressed. And most CPAs, what I've found too is most CPAs are trained to just go hard after taxes, no matter the other cost, and legally doing so, of course. I mean, are there shady CPAs? Yes. Are there too strict CPAs? Of course there are. You get it. But most of them are trained, okay, we're going to do as much as we legally can to lower this person's taxes. That's it. That's my job. And for a lot of the population, that's okay, right? And because that's what they're after when they're looking for a good CPA, a good tax professional, in order to, yeah, lower my taxes. I don't care, whatever, just get that part done. Where outside of that, there's a lot of implications to it. Like you said, mortgage qualification is huge. If your CPA, let's say you made $130,000 and your CPA made it look like you made $30,000, that might be a problem on your mortgage application, right? Because qualifying for a mortgage for most homes today is going to be really difficult on a $30,000 income.
Oh,
So
let's rephrase that. Might, like realistically, probably 100% certain, right?
yeah, I mean, you buy a $30,000 house in, rural Kansas or something,
Okay,
qualify what we're saying here.
you're right.
Kayla's.
You're right. Yeah, because that's what happened
So,
to us. We went to buy a house that we completely could qualify for, but we had showed too much that we no longer could.
yep. And like I said, a lot of CPAs aren't trained to understand what happens outside the tax return. Mortgage underwriters, small business loans, SBA loans, those all use tax returns in order to qualify you for those kinds of loans. So if you look poor to the IRS and to a mortgage underwriter, I mean, there's implications there. You might save a little bit on taxes, legally or illegally, depending on what you're trying to sneak in there. As far as personal expenses, I see that happen all the time. But the implications are there, especially so when you're talking to a standard employee, a W-2 employee, like somebody in the military, for example, we have pay stubs, we have W-2s, we have certificates that the military issues, in a standard 9 to 5 job, you're 40 hours a week W-2 employee. You just get a nice clean pay stub and a W-2. That's really easy to underwrite on a mortgage. Now, for someone who's self-employed, they don't have pay stubs really. Well, they should if they're an S corp, for example. But if you're self-employed, you don't have normal pay stubs, right? You're kind of issuing money to yourself. You should have some payroll if you're doing that right with an S corp, but
But the
it's
problem
different,
is,
right? You're not issued one by your company.
but even if, let's go back, because a lot of our group is the standard pay stub. So let's go back to there for one
Sure.
quick second, right? So like, can you
Okay.
explain, because my husband was the standard pay stubs. Like we buy the house with one person's name and then the other person's name, right? So in this situation, my crazy was not on the tax rate, like was not what they were looking at. But like when they took his rental properties, right? Because we declared too much. Can you explain how it can take a simple W-2 that if you claim too much and how it can like bring that down to like not qualifying?
So yeah, if you have rental properties or income that is not part of a W-2, so maybe you have a side gig, maybe you drive Uber on the side, for example, or you have rental properties, that's a whole different ballgame when you're putting it on a Schedule E on the tax return or on an 8825 if you're a partnership, kind of the same thing in a way. Yeah, so if you go too low on that and you show losses on those, that can bring your mortgage qualifying income down too.
Because it's
which,
basically, it becomes like a car loan, right? Like it becomes something that you have to carry the same thing as like a car loan against like your debt to equity.
yep, that will bring your debt to income ratio down if you're showing a loss on a rental property or on a side gig, depending on what kind of loss it is actually. So if that loss consists of depreciation, you're good to go because depreciation is what's called a non-cash expense, which is totally disregarded on a mortgage application. So I've seen people with zeroed out income with zero income taxes qualify for a pretty fat mortgage because most of those losses were in the form of depreciation. And since those are disregarded to our mortgage underwriters, they still qualified. They look poor to the IRS and rich to a mortgage underwriter. That's what I love to see.
And so that is why, like when we were talking about my specific situation, it was all how we classified the debt or the expenses is what got us into trouble. So like that is why I've asked Dan to come on, and I will stop bothering you, Dan. Thank you for helping. But I really wanted to go that like just because you have a W-2 doesn't mean you're safe. We had a W-2, but we still got ourselves in trouble because when we showed this big loss, they took that against the W-2 and suddenly we didn't qualify. So I really want to like make sure we emphasize that this is not a like 1099 like self-employment problem. This is an everyone problem if you don't do it correctly. Now keep going. Sorry, Dan.
No, you're right. And I do see it more often with 1099 employees because what I've seen more and more over and over and over with self-employed people, especially people who are newly self-employed, like new real estate agents, is they get those tax returns, they get that tax bill at the end of the year and it just blows them away. Because once you become a new agent, for example, or newly self-employed or a new investor, you have taxes on there and they seem to be more than they were as a W-2 employee. So number one, you see as a W-2 employee, they are taken out before they hit your bank account, which seems a lot easier. It's kind of like saving. If and putting in your 401k, if you distribute that out before you get your paycheck, you're not going to notice it nearly as much as if it's given to you and then you have to give it back. But you see that in self-employed people because they receive the money first and then, oh, I have a tax bill. It hurts a little more to write the check than to have it taken out previously and then it never hits your bank account. So yeah, but you do see that 1099 employees, you see that especially powerful because they try to write off everything under the sun, whether that's legal or not. And you should be in touch with a competent tax preparer to see what is and what isn't legal. Because I see people try to sneak in personal expenses all the time. And honestly, most tax preparers don't have time to go through your bank statement line by line. Is that really a business expense? Oh, you can't, that doesn't count. Most of the time, we send you a form, we send you an Excel sheet, you fill it out, you give it back to us. Oh, your marketing expense was $12,382. Great. I'm going to put that in my tax software. I'm probably not going to request to see your expenses unless it's a weirdly high amount. Like, okay, you really spent $85,000 on marketing when your income was 90,000. I might ask a couple of questions there to see if that's legit and if you can back that up. And if it is, by all means, do that. But there's a lot of things we're not auditors. I'm not going to go through line by line or receipt by receipt to see if that's legit. That's up to you. So that signature on the bottom of that tax return, the most important one is my client's, not mine. Like I'm going to guide them as well as I can, but at the end of the day, if they get audited, most of that liability lies on them.
Dan,
So
what do you
to answer
see?
your question, sorry, I'm kind of coming around to get there. But yeah, your tax returns have a lot to do with you qualifying for a mortgage, especially if you have side income, a 1099 income or rental properties, because income or loss is calculated in your debt to income ratio, which is really important in qualifying for a mortgage. If you have too much debt versus your income, you're not going to qualify for what you want. So you got to watch that. You have to have a tax return preparer that understands that. If you're not able to use the services of a CPA or somebody who understands that, you should have a loan officer talking to your CPA before you file them because the loan officer has a good idea of what it's supposed to look like on a mortgage application. And if they're talking, they have a higher chance of that getting what you want.
And Dan, what would you say the landlord might try or might expense that maybe they want to consider not expensing? Or how would you know as a landlord where to like walk that line in preparation of their books before they come to you to actually do their taxes?
Well, just understanding tax law first is the big one. Understanding what is a personal mile versus what is a business mile. Mileage is the way to go, by the way. If you're trying to qualify for a mortgage, that is also not considered a cash expense. So you can either take vehicle expenses or you can take mileage. Like in vehicle expenses, you do things like the cost of the vehicle over 5 years, for example, or 1 year if you do a Section 179. Anyway, besides that, You have like gas, you have car washes, you have oil changes, repairs, or you could take mileage, which is, I think 2023 was 65.5 cents per mile, which is pretty potent. If you elect to do the mileage, you're going to have a better time qualifying for a mortgage. It might be just a little bit, but it's still a boost that is probably going to turn out better for you on taxes anyway, but also will look better on a mortgage application. So mileage, understanding what business mileage is, what isn't. Having a home office is good, and taking advantage of depreciation. One thing I see a lot on the tax, there's two things. Let me finish this before I can see you have a question, Elizabeth, soon, but there's two big things on that tax return on a Schedule E in particular, which is fine if you're investing. It doesn't have to be a partnership or an S corp, but you will want to see. There's two things. The first thing is you want to have the number of rental days correct on that Schedule E. For example, if you bought it in July and you had that rented out and maybe you made half the income as if it were rented out for an entire year, which makes sense, right? If the tax preparer puts 365 on days rented, that's going to bite you on a mortgage application. Okay. Because it's not prorated. If we can prorate it, okay, they only rented it out for 180 days, for example, then we can prorate, okay, this income is based on 180 days, not 365 days. That's a little more powerful when it comes to the mortgage application. It's not going to affect your taxes at all, but those fair rental days are going to matter a lot. So the other one I was going to mention here too is putting it on a Schedule E versus a Schedule C. Now, sometimes if you're doing something like a short-term rental loophole, you can get away with doing it on a Schedule C. However, if that ends up being income that you can't use for mortgage purposes, like you've had been a Schedule C proprietor, like a
Can
sole
you
proprietor for
clarify
less than 1 year.
a Schedule C versus a Schedule E, just for our audience, so they can quickly understand
Yeah.
what you're talking about?
Thank you. Great question. So a Schedule C is for like a small business who hasn't declared to be elected as an S corp for tax purposes. If you file an LLC and you have a side gig, you haven't done any paperwork, you're probably going to end up, your business income is going to end up on a Schedule C. That's kind of the default. And that's fine for a lot of purposes. Great. It can also work for short-term rental or fix and flip income as well. Short-term rental, I would prefer to see on a Schedule E because of that, those fair rental days, for example. And plus, if it's on a Schedule C, then there's rules around that. For example, you can't use Schedule C income unless we've seen 2 tax returns at least for a conventional mortgage. So if that's on a Schedule E, we can use like a single month of that. Where if it's on a Schedule C, we like to see that happening for at least 2 years in order to use that income to qualify for the next mortgage. Those are two things I see missed a lot when people are doing their taxes. One more thing too, there's this thing called other income on the Schedule C, or it's in a partnership tax return as well. Something classified as other income. Generally, when a mortgage underwriter sees that, we can't use that. So if you have income sources that are related to each other, try to get that, or have your tax preparer get that into just your ordinary income. Doesn't change the taxes you have to pay. The IRS doesn't care a lick where it is because they're still getting theirs. But if you have other income, I saw this so many times. Yeah, I have consulting stuff. It's based on real estate, and then I have my rental properties. You can kind of shoehorn that into one regular ordinary income, because if you classify the consulting income as other income, there's a chance we can't allow that in mortgage underwriting. It's annoying, but something to do. Somebody who knows both of those sides can help you put that on the right form.
Can you quickly go through a list of expenses and how you can still declare them as expenses, but they don't impact you as negatively on mortgages? I mean, you mentioned a couple of them, but could we just talk about that really quickly?
Yeah, there's a few of them. I mean, the biggest one is depreciation. That's the biggest weapon in the holster there. So depreciation, and with real estate, as you ladies know, I'm sure, and many of you listening will know, there's a lot of malleability with your taxes using depreciation, especially if you accelerate it via a cost seg study, cost seg estimate, or a cost seg study, cost segregation, if you will, right? And 1031 exchanges, that doesn't really necessarily have to do what's on your tax form that much. It does, and there's tricks to that, but depreciation is the biggest one. Whether you accelerate that or not, that's the best way to look poor to the IRS and rich to the underwriter, is using depreciation, especially accelerated. Another one I see often is repairs expense. If you can time those, we want to treat our tenants as human beings. If there's a leaky roof, repair the leaky roof, right? They're human beings. We want to treat them with respect and dignity. But if you can hold off and try to stack all of your repairs in one tax year, that's going to look better on a mortgage application too. Because what we see as a mortgage underwriter is, okay, there's two things where you can use. There's cash versus non-cash and recurring versus non-recurring. Now, we can exclude non-cash expenses like depreciation, and we can also exclude non-recurring expenses like large repairs. So if we see $15,000 repairs in 1 year and the next year we see $13,000 of repairs, we're going to assume that's part of your normal business cycle, and we're going to deduct your debt to income. We're going to increase your debt to income ratio because your income looks lower. However, if you have $25,000 of repairs on 1 year and the next year you have, I don't know, 300 or $500, we'll probably look at that 25,000. Hey, that was a one-time shot. That's not going to happen year over year. Let's exclude that from their qualifying income, and they can look better on a mortgage application. Okay. Those are the two big ones.
I'm wondering, I have a question. When you do the tax return, does having any sort of, I'm a bookkeeper by trade, so I kind of like to talk that world. Does it help when you're trying to get a loan or future lending if for each of your properties you can produce like a balance sheet and income statement, or is that mostly just derived from the tax forms?
I like that for all my properties. Maybe not for tax reasons, but to really to identify the performance of a given property and to balance it against how is this property doing versus my other one. So it's certainly useful, and I think everybody should do that because how else are you going to understand how your properties are performing? Some people get away with doing it just on the tax return. That's not quite as clean because there's a couple different things on there like depreciation that kind of mess some of that up. So I definitely like to see clean books on each property.
So I
That's
was
a good
told that
question.
once by a lender. He was like, wow, it makes it so much easier that you have financials in addition to your tax returns. And I didn't know if he was just trying to make me feel good or what, but it was like, okay, maybe it was just easier to understand where the numbers come from or for him or whatever.
Well, every once in a while, a lender will ask, and this was a lot more prevalent in COVID than it is today. I don't see it a lot today, but every once in a while it happens where they want to see a P&L, a profit and loss statement. And so bookkeeping comes in beautifully that in that circumstance. It's really nice. But, if you don't have that, like I said, that was a big COVID thing because that was a big scare for mortgage underwriters. Am I taking a big risk here? How are they doing? So, yeah, clean books are nice. That was one reason. Now it's not so prevalent.
So let's talk LLCs. We see it on the forums all the time. Oh my gosh, let's open an LLC. What are your thoughts?
Opening an LLC is a great idea, not necessarily for taxes. A lot of people come to me, it's like, hey, should I file an LLC? And that way I can write off personal expenses as business expenses. And like, no, that's having an LLC has no bearing on what you are able to write off as a business expense or not. The beauty of an LLC is, well, number one, it allows you to file as an S Corp, which matters a lot more for self-employed people who are doing things like real estate agent or Uber driving, whatever. Not so much of an impact on real estate investors necessarily. I don't like to hold real estate in S corps for the most part because it's kind of a minefield when it comes to capital gains taxes being triggered. Transferring it between parties can be kind of a mess when it's in an S corp because you can trigger some capital gains really easy if you don't know what you're doing. It's a lot easier just to hold it in a partnership if you have a good partner, which is the default structure if you have a multiple member LLC, or just even as a sole proprietor. Because the beauty of an S corp is it helps you save on self-employment taxes. And since there aren't really any employment taxes for holding real estate, that doesn't really matter. So, but the beauty of having an S corp for real estate investing is it does provide some limited protection between personal assets and your business assets. If you don't want a tenant suing you, for example, and resulting in the repossession of your personal vehicle, for example, like it's a good idea to have an LLC. Now, they're not bulletproof, so most good attorneys can get around those and go after some of those assets. It does provide some protection, and they're fairly cheap to set up. So get
Well,
one. You don't necessarily need to have one.
not every state. California is $800.
Well, that's cheaper than what, being sued for many thousands. Goodness, yeah. Relatively speaking, it's not a bad idea. And you don't need an LLC for each and every property necessarily. I know there's people who sell services to set up LLCs that will tell you need an LLC for every single property. Yeah, that might be the cleanest way to do it, but you can have 3 or 4 in there, and that's no big deal. What's going to provide you more protection than just having LLC after the business name is having a robust general liability or umbrella policy or landlord policy. It's going to give you far, far more protection than just having LLC after the name of the business.
So let's talk about income, right? So some people are getting started in short-term rentals or have done short-term rentals and they have a great first year. That means they get to count all that income, right? Great first year, woohoo! I get to count that income for the next year. Or how does that work?
Are you talking about on a mortgage application or a tax return?
Sorry, mortgage application.
So again, that goes back to the Schedule C versus Schedule E argument. If it's on a Schedule E, you can use a single month of that income, and that will be prorated to the next, especially if you have a lease agreement that says, yep, I can use this, or you have your prorated days. If it's a short-term rental, for example, and you bought it in November and rented out all of December, let's say you rented out 25 days in December, cool. Make sure on that Schedule E, you have 25 days and not 365, because yeah, then you can immediately count that income as, rental income going forward. Now, if you have that on a Schedule C and you have a good first year, generally most mortgage underwriters, especially for conventional loans, want to see that for 2 years, at least 2 tax returns. So putting it on a Schedule C might not be your best bet on that. So make sure you have an accountant that does it on the Schedule E and puts the right number of rental days on the form. That matters.
That's awesome. So I think you're at the end of our questions, but you've been around all these groups and you've been seeing it. What are some of the things that make you pull your hair out and want to scream when you see on the forums and want to talk about of like commonly mistakes that people think that aren't true?
Well, sometimes it's what I see other CPAs put on the tax return, honestly. Those who don't specialize in real estate or know the rules for mortgage underwriting, which, very few of us do know mortgage underwriting rules. I don't really blame them for that. But when it comes in there, they put it on the tax return, they filed that tax return. So in order to change that, they'd have to amend it, which is a big red flag in mortgage underwriting. Things like how they classify debt is a big one. So if they have something in mortgages and notes payable within 1 year, that has to be counted as a current expense in the current year on the mortgage application. So there's another way to do that. That's kind of something I do. Yeah, that's kind of the most annoying thing. More annoying things are clients who push really hard for me to do something illegal. I do not like when people, hey, write this off. Hey, can I write my dog off? I want to write my dog food and their vet expenses. And like, well, are you a farmer? Or does that dog do like sheep security? That's pretty much the only way to do that. But they try to be shady. And what I find fascinating too is regular W-2 employees end up paying more in taxes than self-employed people do. That just happens. And I'm not a fan, I've never been a fan of how efficiently the government spends our money, no matter what party's in charge, no matter who's making the rules. I haven't been feeling like we get our money's worth when we pay our taxes, but the wrong way to protest is on the tax return. So I don't know, people pushing me to try to be shady, like I'll just drop you as a client. No thanks. I don't need that. If I get audited, the chance that my other clients get audited goes up. I don't want that for my clients. Trying to ask me to put things on there that aren't allowed, like, I'm not going to do that. That's not good for anybody. It's not good for you, especially if you get audited. Just do it by the book. I had somebody last year who was trying to qualify for a mortgage. They knew what I do. They knew what my specialty was. And they wanted me to prepare the return. And they said, okay, I know what I did last year. I want to show zero in expenses for this tax return. Like, you're a bakery. You have rent. You have to buy flour and eggs and sugar and, whatever it takes to make a cake and all this kind of stuff. And she's like, I want to show zero as expenses. I know I'll pay more in taxes, but I want to qualify for this mortgage. And I wouldn't do it. And she kept pushing and like, you know what? Have somebody else do it. That's fraud. That's mortgage and tax fraud. It's not a good idea to get wrapped up in those.
So how does someone get started with you? Like, for example, I'm hearing about this and I know that we're going to acquire more properties and I just normally have a CPA do my taxes and I move forward from there. I have never heard of a CPA mortgage guy. So if you're just like me, a landlord who has never heard of you, how would someone get started with you? Like, do you need to do my taxes? Can you do an audit of my taxes? Do I bring my stuff to you every year, every 3 years, or only when I'm making a decision? Like, what does our relationship look like, Dan?
And what states do you operate in?
Well, I live out of Utah. My something I can offer for those nationwide is, yeah, I can do I wouldn't call it an audit. That's not a great word to use in the tax realm. But well, in a sense, that's kind of what it is. Like I can do a review or a consultation looking at your tax returns and say, okay, this is how much this would get you mortgage wise. I mean, I'd have to know some other things about you. I'd want to know expenses. If you want me to go as far as pulling your credit, we could do something like that too, because that will give me the most accurate picture of your debt to income ratio. But if you just want me to like, hey, Dan, here's my taxes. Will you look at them and then hand them off to my tax professional I will do that if it's a draft and not fully filed, because filing an amendment, like there's some types of loan, like a VA loan, Elizabeth, that
Yep.
if you have amended returns within 6 months, they don't like that at all. Like they might even throw out your application. So hand it to me before you send it to your CPA in a
Okay.
draft form. I will review it. I'll charge a small fee for that. And then,
Yeah, because
yeah,
you
you
do
can
that for
hand
me
that to
now.
your, sorry?
You do that for me now.
Yes. Yep. I do that. And I don't have to file your tax returns. I'm pretty picky on who I choose for tax clients. There's a supply and demand problem enough to where I can choose who my clients are or not. So I don't have to do your tax returns, but I can look over your tax return before you give it back to your CPA and sign your 8879 saying, yes, we're good to go. And I'd be happy to do that because it helps more people own more real estate. And I'm a big fan of that.
Yeah, so not to butt in, but that's what Dan and I do. That's how I met him. I actually use friends of his, and I was really big into like, I gotta make sure that like we are doing this properly. And he was the one who taught us like the depreciation and like you have to have expenses, but you can do it correctly. And so now Dan reviews all of my tax returns. I drive him nuts, and Dan reviews all of my tax returns before we submit them.
And so what if someone is a landlord who has submitted tax returns, but they see growth in their future and they have you do a review? Is it something that if you identify things, they can turn around in what kind of time period? Can they turn it around before they file their taxes that year? Or is it something where maybe they have like a year plan, a 3-year plan of like how they're going to get on track for like having the perfect tax return for a mortgage?
Well, I need to get a sign that says it depends, and I need to push a button, it'll light up because I say that so often in my CPA work. It depends on the individual. It depends on prior year tax returns. It depends on how long you've been a landlord and how, yeah, what your tax returns look like last year, what you expect to make in the current year. Like that's a big fat depends. I like to 2 years of lead time is if you're trying to qualify for a conventional mortgage is what we like to see because we use two tax returns. So the earlier you can get that in, the better. Now, there comes a time sometimes when, you're simply not going to, there's limits to what I do, right? I'm not going to get, not everybody's going to qualify for a mortgage because I can't magically give you more income on your tax return. That's illegal too, by the way, even if you owe more in taxes, but are also things I can do. I can do DSCR loans nationwide, for example. Every single state I can do those. And if you can't qualify for a mortgage with your tax returns, there's something else there too that I have a solution for. You can still get something like a DSCR loan
Can you
in order
explain
to still
what
get that property. I'm sorry.
my our demographic would not understand what DSCR loan is? Can you explain what that is?
Okay, great. So DSCR loan stands for debt service coverage ratio. And instead of using your income to qualify for the mortgage, they use the income or the potential income of a given property. So
So can
the
we
interest
talk
rates.
about how, because that's how I qualified for the loan that I was so upset about, right? So when that's what we had to do when we couldn't use our own tax return, we had to use a DSCR loan and then rent the house out for 2 years in order to qualify.
Yeah, that ended up being your situation. How'd you feel about the interest rate you got on that DSCR loan?
And that is why I always go to Dan to get my tax returns checked. So our interest rate, just for our audience, was a 9% instead of a 5.65, and we had a 3% fee in order to use it. So it is not what I recommend, but it worked for us at the time because the house was one that we meant a lot to us. So that is why it was so important to me that when Sasha and I were coming up with courses that we got Dan on here, and I'll let Dan keep going, but I wanted to make sure to really explain what DSCR loan is and like also how it can help if you can't use regular tax returns. But there's a cost.
Yeah. So that's still a thing. Yeah. And sometimes if you find the deal of a lifetime, you can't pass up, and right now you're not going to qualify for conventional financing, get it with the DSCR loan and then work within the next couple of years to get your tax returns in order so that you can qualify within that next year or two. That is a thing because we can refinance you out of a DSCR loan into something like a VA loan if you live there, for example, or just a conventional loan as for investors. That's probably going to get you a better interest rate.
And then you were still
Any
going.
other questions?
You stop about the DSCR if you want to continue.
So DSCR loans, okay, yeah. So they use the income of the property. They do not ask for tax returns. They don't want to see W-2s or pay stubs. They just send an appraiser out that essentially goes out and sees what will this property rent for. And if there are already tenants in there, that makes it pretty easy. And they will still do a market analysis to see what that place could rent for. And they will take, a current lease agreement into account, of course, but also like they'll match it up with the rest of the market. What can this place rent for? And if that ratio can pay at least the mortgage, you're going to get decent terms on that. Well, not better than conventional, but better than you could if, the cash flow isn't there. It's because we do have lenders that will do DSCR where, let's say, the rents end up being $3,000 and the mortgage and expenses and principal, interest, taxes, and insurance ends up being $5,000. I'm talking about a big property, I get it, but there's still lenders that will do that. Your rates and points are going to be probably pretty high because that's pretty risky to them because that property isn't quite paying the mortgage, but you can still get that. Now, if your cash flow, let's say you flip it around, your cash flow is $5,000 on that property and the principal, interest, taxes, and insurance payment is $4,000, you're going to have an easier time getting that loan. You'll have better rates and terms on that because it's cash flowing significantly more than the mortgage payment is. So that can be a great loan for investors, especially if their tax returns make them look poor to a mortgage underwriter. And then, like I said, you can prepare within those 2 years to maybe refinance into a conventional loan.
Is there anything else just very important to landlords that we should know from you?
Yeah, well, a couple things. Asking your accountant to amend a return in order to qualify for a mortgage is, I kind of hinted on this earlier, but it's bad news. That's illegal if you're doing it for the sole purpose of qualifying for a mortgage. You're not, that's going to raise some red flags with both the IRS and the CFPB, Consumer Financial Protection, something like that, Bureau. But so yeah, I need my tax return. Let's amend it so we can qualify right now. Likely answer is we're not supposed to do that. If there's a blatant disregard for something, or you have a major change, like maybe we did a cost seg study and we did that retroactively, that, we might be able to make a case to do that and still qualify. But if it's only for the purpose of qualifying for a mortgage and you're going to throw out a bunch of expenses that were legitimate, your tax preparer shouldn't do that. That's not legal. So I just wanted to make sure people knew that, and we're not going to amend a return for that.
And that must be why you alluded that lenders, that's a huge red flag to them, probably because you wouldn't amend taxes that drastically for any other real good reason.
Yeah. Yep. That's a red flag because why else would you amend a tax return to increase, especially if everything else looked good?
Yeah.
You know?
So what about
So some lenders, I mean, that's a game that some lenders have seen people try to play a lot. So like, it's not original. If you're trying to do that, they know about that. They're onto it. So
everyone sees you. What about if you're a landlord and you want, like, we have a lot of landlords who don't use property managers and they self-manage their properties, and they're not corporations, they're not taking a paycheck from that. Can they charge to the company property management fees that they do on their behalf, or would that be not legitimate?
Again, it depends. That's a wonderful answer you'll hear accountants say all the time. The big depends there is, depends on how many units you're managing. If you've got 4 or 5, and there's legit expense there, I don't know, that's about the threshold. If you've got, 40 units, it's pretty easy to justify. That's a full-time job. Somebody needs a salary in order to legitimize this stuff. Let's get somebody on payroll. Let's pay them a decent salary. Maybe set up an S corp in order to lower their self-employment taxes if you're doing it yourself. But again, that kind of depends on how many units you've got under management.
Okay. Yeah. We hear that a lot with, like, also, I know it varies state to state, but if a landlord does repairs themselves, can they charge that to the tenant? But well, maybe you can or can't, but you can definitely write it as a repairs and maintenance, against your income. So it kind of falls in
And
that
you should.
question. Yeah.
Yeah, that will lower your taxes. Again, if you're trying to qualify for a mortgage, you might want to balance that out with something. But yeah, I mean, it's a legit expense. You should lower your taxes by that, sure.
You've answered all my questions, Dan.
Do you have any other things that you commonly see from the, smaller landlord, maybe with the 1 to 10 properties, that you want to share, impart your wisdom?
Maybe understanding your mileage deduction a little bit better. Having a home office will greatly boost that. Yeah, I don't know. That's as far as I see more from agents trying to slide stuff in there sneakily than property managers. A lot of states, you have to be an agent to be a property manager anyway. You have to have that kind of license. So I don't know. Just people being shady. Like, my rule of thumb is, if you are okay writing off an expense to the government, the proper mindset there is, would you be okay reimbursing an employee for that expense? So, for example, I had one agent who, gosh, this drove me nuts. I fired him that day. He told me, "Hey, you know what? I write off my family's groceries because when I go to the grocery store, I go to the cashier and I talk to him about real estate, and therefore that's all a business expense." And that was his attitude. And he just kept pushing it. And you know what? We're done. You find another person to do it. Dump it into TurboTax if you want to. I don't care. But just, trying to get away, trying to pull a fast one on the IRS is risky business. And there's great ways to do it legally that will drastically lower your taxes without having the stress of wondering, will I get audited? Because that's a very real cost. I mean, maybe not in dollars. It could be if you do get audited, but also in personal stress. Because audits, you're not notified as that you're going to get audited for, several months and sometimes a couple of years sometimes after you file that return. So is it worth it to live through that stressfully? Like, hey, I sent something in, I put my family's groceries on it. I know that's not allowed. I'm going to worry this whole 2 years I'm going to get audited. That's not worth it to me. Spend more time finding better deals, spend more time, getting more tenants. Running your business is going to save you more stress and more money and make you more money overall, which is what we all want. It's not about saving money. It's about making money overall, profits, right? So spend your time doing what you do best, bounce your tax questions off your tax professional, and try not to do anything shady on purpose. That's risky business. So
Those are all words that all landlords should live by, right?
I would hope so.
Well, we sure are glad that you joined us, Dan, and we'll definitely share your contact information with all of our landlords and encourage them to reach out to you. I mean, it sounds like they need to reach out to you whether they're thinking of growing now in their portfolio or whether they think they will in 2 years to 5 years even. So we really do appreciate you imparting your wisdom on us.
Yeah, thank you for coming.
Sure.
I appreciate all that you do, and thank you for sharing us both like how to, what was legal and not legal, because I know you all know my motto is stay legal. So it's nice knowing how to do that. So thank you.
And I think too, I mean, when we
You're
talk,
welcome. Happy to help.
yeah, this landlord or, legal versus legal, I think sometimes landlords, they don't have any ill intention necessarily. It's just lack of knowledge. Like the question is there, they think it seems right, but if you've ever read a tax publication, it's confusing. Maybe it's not to you, Dan, but to the rest of us, it's a little confusing. So
Yeah, I see strokes of genius in the tax code, believe it or not, and I see absolute dumb, stupid things in there too. So it's, you know,
but that's why we need you
it's interesting to see how that works.
just to speak it for us.
One final question. I know you said you do DCSRs in all 50 states. What states you do conventional VA and those loans?
So our office is licensed in our home state of Utah. We have California, we have Florida, we have Texas, we have Idaho. We're working on Tennessee and North Carolina currently.
Wow. Okay.
Awesome.
Those are great markets.
And if I remember correctly, you are taking tax clients right now, correct?
Yes, on a limited basis. Yeah, I'm selective on who I do that for because I can only spend so much time being an expert on both taxes and mortgages. So in order to keep my expertise top notch, I keep my book of clients thin on the tax side. However, I do study that because it's really important to my clients. So one more thing I would advise a lot of landlords to do, get your real estate license if you don't have it, because even if you don't sell your tenants, I mean, you have a very captive audience to sell your tenants' homes. Whether you do that or not, or if you decide to refer that out to another real estate agent, get your license. You can collect your 25% referral fee and have nothing to do with the license other than referring business to your favorite agent. You can collect, a good amount of commission doing that. So that would be something a lot of landlords miss if they don't do that already. Get your real estate license. It's not hard to maintain. It's not overly difficult to achieve for most places. So that's somewhere to, boost your income. And I hope as the landlords, and I hope you guys do this at the Landlord Hub, is have some first time home buyer material that you can show to your clients, to your tenants. Because home ownership is going to build their wealth. Would you rather have a 25% sales commission on a new house for them, especially if you have a waiting list out the door to rent your properties? You can have the best of both worlds. So that's something I would recommend my tenant clients to do.
Well, thank you. Well, thank you again for joining us, and thank you everybody for attending our class for Landlord Help Hub. We hope that you'll leave comments, and then we hope that if you have any more questions that you'll reach out to Dan. And as always, guys, if you think that there's more things that we should provide, more topics that we should cover, if we should have Dan back and cover some more stuff, please reach out to Sasha and myself so we can make that happen. Thank you again for attending this course.